The American dream: to be happy, financially prosperous, and to own your own home.
Imagining owning my own home. Every young person, every young family, particularly, uh, when they began to have children, wanted to own their own home.
For many Americans, however, the home ownership dream was never possible. They had bad credit or did not have enough savings for a down payment. All this changed in the 1990s as greater home ownership became a reality. Through numerous governmental programs, banks began to issue home mortgages to people who previously were thought to be unqualified. Unfortunately, the result of too many mortgages to unqualified individuals resulted in the crash of 2008.
A unique situation developed where the inner cities were losing uh, their working middle class, and the housing in the inner cities, for the most part, fell into disrepair or turned into rentals. And the banks began to use very discriminatory lending policies. Mm-hmm. They would do what's known as redlining an area, where if on a map there was an area where they felt a home loan would be a poor investment, they would actually not make that loan. Mm-hmm. So in the 70s, government became concerned about this.
Governmental programs were a strong factor in the issuance of mortgages to individuals previously thought to be non-credit worthy. One such program was the Community Reinvestment Act. Originally passed in 1977, the Community Reinvestment Act encouraged banks to help meet the credit needs of low and moderate income neighborhoods. Amended by President Clinton several times in the 1990s, the Community Reinvestment Act amendments further encouraged banks to make weak loans in an effort to eliminate discrimination and increase home ownership amongst all Americans. Another governmental program that ultimately resulted in looser lending standards was the Housing and Community Development Act of 1992. The Housing and Community Development Act established a loan purchase mandate which required Fannie Mae and Freddie Mac to buy affordable loans. Affordable loans are defined as loans to borrowers who are below normal lending standards. To comply with this federal mandate, banks were required to relax their lending standards.
And in order to help people, they formed a organization, uh, Freddie Mac. It was similar to Fannie Mae in that it was federally funded, federally organized, but privately owned. Mm-hmm. And consequently, this organization began to make loans and make them
Riskier loans.
Well, they made loans. It was an easier process, mm-hmm. And little by little, the Congress put pressure on Freddie Mac to reduce the lending requirements to the point where they actually, at one point, eliminated the need to actually show how much money you had in the bank, or they eliminated the need for you to show what your income was.
Mm-hmm. As lending standards relaxed, the number of mortgages issued to people with poor credit greatly increased. These risky loans were called subprime mortgages. A subprime mortgage is a type of mortgage that is normally made out to borrowers with lower credit ratings. As a result of the borrower's lowered credit rating, a conventional mortgage is not offered because the lender views the borrower as having a larger than average risk of defaulting on the loan. Lending institutions often charge an interest on subprime mortgages at a rate that is higher than a conventional mortgage in order to compensate themselves for carrying more risk. In addition to offering loans to people with poor credit, new mortgage standards were introduced. Where previously people had to have had at least a 20% down payment and document sufficient income to repay loans, new mortgage loans often did not require such down payment. For example, in 2006, over 40% of first-time home buyers bought a home in California without a down payment. Standards regarding documentation of down payment or the source of funds needed to repay the loans also were relaxed. Further contributing to weaker loans were mortgages such as variable interest rate and interest-only mortgages. In the past, most mortgages had a fixed interest rate that paid back principal and interest over 30 years. The new mortgage types sometimes only paid back interest, and the interest rate could increase during the term of the loan.
Loans. Most of these loans were made on what was known as ARMs, variable rate mortgages that had a fixed period of 3, 5, or 7 years. Mm-hmm. And at the end of that period of time, the mortgage interest rate was free to float. It was an easy entry thing to buy a home, but when those interest rates began to increase and their low interest period was over, they began to have trouble.
Yeah. All of these policies initially seemed to work, and home ownership increased. However, in 2008, the dream of increased home ownership backfired. People wanted so desperately to own a home, they took out loans they could not afford. Because mortgages were given out easier, the price of houses skyrocketed as more and more people bought homes. They hoped home values would continue to rise, but interest rates would remain the same. This didn't happen. Interest rates began to rise and property values stopped rising for the first time in many years. People with these subprime mortgages could not make the payments, nor could they refinance at a lower rate. Thus, they were forced to sell or give their homes back to the bank. As this happened, the real estate market hit rock bottom. For the first time since the Great Depression, the housing market tanked. Experts point out there are many factors that went into why the housing market crash of 2008 happened, but the primary cause is widely believed to be the subprime mortgages. When the market came crashing down, it took its toll everywhere. And while some places, like Greenwich, where there's not much low income, were able to recover quickly, or quicker than some places, other low-income areas in the Fairfield County and all across America have yet to recover.
Greenwich is a strong residential and commercial real estate market. We're typically the last market to go into a recession, and we're the first market to pull out of it. Mm-hmm. So in Stamford, Norwalk, and the surrounding communities, they have not made it back, and in my opinion, may never get back to the 2007, 2008 market.
Not only was the economic impact from the housing crash of 2008 immense, but there were significant psychological effects. Millions and millions of homes around the U.S. were foreclosed, and families were forced onto the streets. There were more than 3.1 million foreclosure filings issued during 2008, which means that 1 of every 54 households received a foreclosure notice that year alone. To date, the housing market has not recovered, and to many, the American dream of home ownership might never again be realized, due in large part to the devastating impact of subprime mortgages.